Well, hello there, dragons, and welcome to this instructional video for Lesson 6, Part 1, Defining Fiscal Policy. The main idea behind this economics lesson is the government uses fiscal policy to influence the economy. With that in mind, by the end of watching this video, you'll be able to explain the role that taxes play in fiscal policy, describe the kinds of tax rates that governments set, and identify the most profitable taxes. Now that the outcomes for this lesson have been shared with you, let's get started. The Federal Reserve System uses monetary policy to influence the economy. Another tool the government can use for this is fiscal policy, or spending, taxing, and borrowing policies. The government collects taxes to pay for programs such as road construction, education, and national defense. The government also uses taxes to influence the behavior of individuals. For example, the federal and state governments have placed taxes on products such as tobacco and alcohol, in part to discourage people from consuming large quantities of these potentially harmful substances. Taxation is not random. Governments can choose among three basic types of tax rates: proportional, progressive, and regressive. Whether a tax is proportional, progressive, or regressive depends on the tax rate, the percentage of a person's income that goes toward taxes. Some states have proportional taxes, also called flat rate taxes. A proportional tax takes the same percentage of income from individuals at all income levels. To understand how this type of tax affects taxpayers, suppose that a state has a 5% proportional tax on income. If Nathan earns $100,000 per year, he pays $5,000 in taxes. Stephanie earns $10,000 per year and pays the same 5% rate, or $500. Although the tax burden appears to fall equally on all taxpayers, it is probably easier for Nathan to pay the 5% tax than it is for Stephanie. Proportional taxes, therefore, have a greater impact on people with lower incomes. A progressive tax takes a larger percentage of income from a high-income person than from a low-income person. Currently, the main progressive tax in the United States is the federal income tax. Under current income tax laws, there are different tax rates for people with different levels of income. For example, a person with a taxable annual income of $24,000 or less falls into the 15% tax bracket or category. Those individuals who have a taxable income of more than $263,750 are in the highest tax bracket, 39.6%. These tax brackets cause the burden of the federal income tax to fall more heavily on people with high incomes than on people with low incomes. In addition, income below a certain level is not taxed at all. A regressive tax takes a larger percentage of income from members of low-income groups than from members of high-income groups. Sales taxes are one kind of regressive tax. A sales tax is levied on the sale of some goods or services. How is a sales tax regressive? Suppose that Dean and April each buy a paperback book priced at $5.99 with a sales tax of 7%. They each will pay $6.41 for the book. $5.99 for the book plus 7% sales tax is $6.41. The money paid in sales tax, however, is a larger percentage of Dean's $18,000 annual salary than of April's $25,000 salary. With a regressive tax, therefore, the tax burden falls more heavily on people in lower income groups than on people who earn high incomes. 45 U.S. states and the District of Columbia have sales taxes, with rates generally ranging from 3% to 8%. In addition, many cities such as Los Angeles, Chicago, Dallas, New Orleans, and New York City have city sales taxes. Governments rely on a combination of proportional, progressive, and regressive taxes to collect funds. The largest sources of tax revenue are individual income taxes, corporate income taxes, Social Security taxes, property taxes, and sales taxes. The individual income tax is a progressive, and in some cases proportional tax on a person's income, including wages or salary, interest, dividends, and tips. Individual income taxes are collected by the federal government and most state governments, as well as some local governments. Wage earners pay individual income taxes through a payroll withholding system. Employers deduct tax money from employees' paychecks and forward it to the government. Various government agencies, for example, the federal government's Internal Revenue Service, or IRS, a branch of the Treasury Department, collect the taxes. This pay-as-you-go system of tax collection also applies to self-employed workers who pay regular estimated tax payments, approximations of what is owed, to the government. In 2019, individual income taxes provided about 50% of federal revenues, about 28% of state revenues, and less than 4% of local revenues. In the United States, governments tax corporate profits. Many corporations pay taxes at reduced rates because they are eligible for tax breaks, such as those designed to promote plant modernization. In 2019, corporate income taxes made up about 7% of federal tax revenues, about 6% of state tax revenues, and less than 1% of local tax revenues. Like individual income taxes, Social Security taxes are withheld from workers' paychecks. Withholding of these taxes was authorized by the Federal Insurance Contributions Act, or FICA. They are used to finance two social welfare programs. The first is Old Age, Survivors, and Disability Insurance, or OASDI, more commonly known as Social Security. The second is Medicare, which provides health care to older Americans regardless of income. FICA taxes are both proportional and regressive. How can this be true? The FICA tax is proportional because it takes a set percentage of an employee's wages, 7.65% of incomes up to $57,000 in 2019. Income above that amount is taxed at a lower percentage, making the tax regressive as well as proportional. For example, suppose that Lily makes $20,000 per year, Matt makes $57,600 per year, and Alicia makes $70,000. Lily and Matt will pay the same percentage of their salaries, 7.65%, in FICA taxes. Alicia will pay 7.65% on the first $57,600 of her salary, and a lower percent on the remaining $12,400. The tax burden, therefore, falls equally on all people making $57,600 or less per year, but less heavily on people making more than $57,600 per year. This means that more of the FICA tax is paid by people who are less able to afford it. Social Security taxes are the second largest source of revenue for the federal government. By 2019, they represented 36% of the federal government's tax revenue. State and local governments also rely on property taxes. Most property taxes apply to houses, factory buildings, condominiums, the land on which these structures are built, and undeveloped real estate holdings. Some states also collect taxes on personal property, such as household furnishings, boats, and jewelry. Local governments rely on property taxes to finance needs such as education, police and fire protection, and sanitation. Despite its common use by state and local governments, The property tax often is controversial because it does not take a person's income into account. For example, consider a retired couple living on a fixed income and owning a 3-bedroom home on a large lot. Despite their fixed income, the retired couple probably would pay more in property taxes than a wealthier couple living in a condominium apartment on a small lot in the same neighborhood. Critics of property taxes also point to the unequal results. Local governments that collect large amounts of funds through property taxes can provide quality education, recreation facilities, police and fire protection, and other services. Towns and cities that do not raise much money through property taxes, however, sometimes provide inadequate public goods and services. Although traditionally property taxes make up less than 1% of state revenues, they provide more than a quarter of revenues for local governments. A sales tax is a regressive tax assigned to certain goods and services by state and local governments. Sales taxes are regressive because generally they apply only to basic consumer spending and therefore take a larger percentage of lower incomes. Although the amount of tax paid on items is the same for people with higher and lower incomes, that amount is a greater percentage of a lower income than of a higher income. Additionally, sales taxes do not apply to many higher cost items such as houses or to services such as attorney's fees. People who can afford these products therefore do not experience the same sales tax burden as people with lower incomes. Some states that have sales taxes do not tax food, medicine, clothing, and other necessities. These exemptions soften the economic burden of sales taxes on low and moderate income groups. In 2019, sales taxes provided 5% of federal revenues, 22% of state revenues, and 5% of local revenues. An excise tax is a tax on the manufacture, sale, or consumption of a particular good or service. The federal government places excise taxes on products such as gasoline, tobacco, firearms, alcohol, telephone services, and tires, as well as various forms of gambling. Excise taxes are regressive taxes because they tend to take a larger percentage of income from members of low-income groups than from members of high-income groups. Estate and gift taxes are taxes on houses, cars, jewelry, and other personal assets when they are transferred from one owner to another under specific circumstances. An estate tax is a tax placed on the assets of a person who has died and is paid out of this estate rather than by the individual. Federal estate taxes are levied only on estates worth more than $600,000. A gift tax is placed on the transfer of certain gifts of value, such as money or other personal property. The gift giver pays the tax if his or her gifts to an individual exceed $10,000 annually. A customs duty is a tax on imported goods that are brought into the United States from other countries. A customs duty is also referred to as a tariff. Excise taxes, estate and gift taxes, and customs duty represented another 6% of all federal tax revenues in 2019. So that's the way it is with Lesson 6, Part 1, Defining Fiscal Policy. At this point, you should know that governments use their income and expenditures to manage the economy, and federal, state, and local governments in the United States finance their operations through various kinds of taxes. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons. See ya!